Hello, and welcome again to our fourth quarter strategy review for 2018. Once again, we picked an auspicious day. We met here on September 27th, a day that will probably go down in infamy with the hearings going on in the background. And we also, of course, did cover the idea of the midterm elections, but both of them, as you'll see as we go through our review, were items that we felt were certainly important, but not really that effective in terms of what was happening in the markets. At any rate, meeting with us, we had a larger group than normal. On my far right, we have Nat Bowie. Nat has been with us now for a little over a year. She is a paraplanner studying for her CFP, and this is her first opportunity to be on camera. Next to her is Len Skeena. Len, Vice President and CEO of the firm. And on my left, Bob Toomey, Vice President and Director of Research. Also joining us in person was Art Nunez. Art is with Northwest Asset Management, and similar to us, has been managing other people's money for over 30 years. So again, welcome, and with that, I'd like to turn it over to Bob for some outlooks on the market.
Great, thanks so much, Stan. So the first thing I want to address, and as Stan mentioned, when we go into these meetings, we cover a lot of ground. We cover a lot of different aspects of the economy, the financial markets, politics, geopolitics, and all of that. So I think what's important right now with respect to the U.S. markets, particularly the stock market, is the economy. I'm sure, as you're well aware, the economy is hitting on all cylinders right now. We're looking across business and consumer spending remains strong. Capital spending remains strong on the business side. And the good news is with the changes in the tax laws, many companies are repatriating money from overseas. That money is getting recycled back into the economy in the form of share buybacks and rising dividends and increased hiring. And all of that is sort of what I call a virtuous circle, if you will, that we think is positive for the economy now and looking forward. All of that is positive for earnings. Right now, corporate earnings remain very strong. We think corporate earnings in this upcoming third quarter will be growing in the mid-20s, and we see a couple of more quarters like that, a very strong 20% plus type growth. Some moderation next year. That could end up being a problem next year, but as of now, earnings still look very good, and I think that's why you're seeing the stock market so strong. With respect to inflation, is something that does have an impact on the financial markets and interest rates. We do think inflation is going to rise a little bit, but we think the increase will be moderate. At this point, we don't see inflation, even though it will be rising somewhat, we don't see it as being deleterious, if you will, to the overall economy or causing the Federal Reserve to accelerate its rate increases. With respect to the Fed, they had their FOMC meeting this week. It came out as expected. The Fed did raise the Fed funds rate again, which we expected. We expect that they will raise again in December and probably March and June of next year. So the Fed remains right on track with what they've said they're going to do, and we don't expect any major surprises. And that also is a positive for the market. When the Federal Reserve can have an impact on the outlook for the markets and can cause investor concerns. Right now, we think the Fed is doing its best to keep a steady rate policy and a steady policy overall that's supporting the markets. So, as you know, the markets have been hitting new highs of late. We're still positive on the market due to these fundamentals I discussed, but we have become a little more concerned about valuation. On a number of measures, the market does appear to be high on a valuation basis, and we did take some steps to reduce or mitigate risk in your equity portfolios this quarter, and I'll talk a little bit more about that later on. I'd like to turn it over now to Len to talk about fixed income.
Thank you, Bob.
As Bob mentioned, this week the Fed did raise rates for the third time this year, and we expect them to raise them probably another 3 or 4 times in the next 12 months. This is consistent with what the Fed has been saying they wanted to do, and it has resulted in a rising rate environment for the last year or so and for the year that we anticipate coming up. When interest rates rise, fixed income bonds are negatively affected in their prices. And for that reason, we have skewed things towards the short end of the curve more than the long end of the curve, because shorter term securities tend to be less interest rate sensitive than longer term. In addition, we've tried to eliminate some of that interest rate risk by putting a significant portion of the fixed income portfolio in floating rate bonds that are going to get adjusted as interest rates change and will therefore add an additional level of stability to the bond portfolio that we have. This has worked out very, very well so far this year, and it has resulted in our bond portfolio comparably doing much better than the indexes in the treasuries. One concern that we do have with respect to the interest rates rising, however, is that the Fed can only affect short-term rates. They cannot affect longer-term rates. Those tend to be much more related to market sentiment as well as inflation concerns. And so it is quite possible that the Fed can push up short-term rates, and longer-term rates may not respond quite the same way, to the point that actually short-term rates can exceed longer-term rates. When that happens, you have something called an inverted yield curve. And that's a concern because the last several recessions have all been preceded by an inverted yield curve. When we looked at our triggers, this is one of the triggers we put in place, and Stan will talk about that a little further in when he discusses our triggers. With that, I'd like to turn it over to Stan to talk about REITs.
Thanks, Len. And of course, REITs actually do go along with the interest cycle and the interest sensitive activities that we will continue to discuss as we go through the meeting. As REITs do provide a very strong amount of income in the form of dividends, we still favor REITs from that perspective. But we are more concerned about some of the underpinnings of the REITs, such as large apartment buildings and probably specifically shopping centers. However, again, they are a very nice and a very good component of our overall portfolio returns. This quarter, though, we decided to again shift away a bit from the normal REIT structure, which has those 3 underpinnings, and emphasize actually medical properties. The idea being that medical properties, because of what is happening to the economy relative to the current activity in the medical area, might actually do a bit better. And we also found that a medical property REIT, which has actually a larger dividend than even the normal REITs that we've been owning in the past. With that, I'd like to turn it over to Nat for comments on the international area.
Thanks, Dan. On the international side, there has been a lot of talk and things on the news lately, and we continue to be underweighted in international and no longer looking at emerging market. The reason is we feel like with the slowdown in China economy as well as trade war, the strong dollar and higher US interest rate is not a good time for us to get back in, and therefore we decided to hold back on emerging market and continue to emphasize on large developed EFA areas, which consists of Europe, Australia and Far East. And with that, I'm going to turn over to Bob to talk about change in our model.
Thanks a lot, Nat. And so, as you know, at these meetings, we not only talk about a wide variety of macro factors, but we look at your portfolios. We look at the holdings in your portfolios, and we really try to decide which investment vehicles, primarily ETFs, as you know, we think are going to be best suitable within your portfolios based on our macro outlook. So we did make some changes this last quarter, and as I mentioned in my earlier comments, we did a little to mitigate equity risk in the portfolios. We did not materially reduce equity exposure, but we made a couple of changes that we think would reduce equity risk in the case that there is an unforeseen decline in the market. As I mentioned earlier, valuations on a number of measures are high right now. And we believe that we've been in a long bull market. We have not had a true correction in quite a long time, and certainly have not had a bear market in, I think, about four years. So we feel as a group, as a committee, that it was time to take a little bit more risk mitigation. So what we did was we increased our exposure to value, because value stocks tend to have lower PE multiples and higher dividends, which makes them a little less volatile in a declining market. We also added a holding in the telecom area. It's a sector that has underperformed the last year or two, but we think that it's attractive on a valuation basis, and because it has lower valuation and has underperformed the market for the last couple of years, we think the risk reward there is attractive and probably has a little bit less downside volatility in the event that there's an unforeseen decline in the market. We also enhanced our inflation hedging this quarter. As you know, our models do contain a component for natural resources and commodities as an inflation hedge. We added a holding in industrial metals because we feel that if inflation does accelerate somewhat as we expect, industrial metals tend to be a good inflation hedge. With respect to our sector investments, we continue our select focus in healthcare devices and technology. That has proven to be a very good long-term area of growth that has outperformed the overall stock market for a long time. And we also maintain a sector emphasis in financials, which we believe are continue to remain attractively valued and should benefit from rising interest rates. With that, I'm going to turn it back to Stan for closing comments.
Thanks, Bob. And thanks to everybody who participated in the meeting on the 27th, and especially to Nat for being on the video today. These videos, of course, have been going on for some time, and we hope that you will continue to follow them. I, for one, as I don't come into the office every day now, really look forward to the quarterly reviews because it really does bring me back to center. And as I say, I think it will give you a similar capability. So I hope that you too will tune in as we go forward. The meeting yesterday, or the meeting on the 27th, I should say, went very well, and I think we made some excellent decisions. And again, let me point out that we did look at the current political environment, which is certainly one that is fairly volatile, but really commented and felt that it did not have a strong impact on what was happening in the markets. Even proved by the day of the meeting, markets were going up slightly while those hearings were going on. However, we were concerned, as I think you got the feel, for interest rates. And consequently, our triggers really have to do with interest rates. Remember, triggers are things that we do not expect to happen. And if they did happen, then we would take action which was predetermined at the quarterly strategy so that we wouldn't do it in the heat of battle, so to speak. So the triggers that we set, again, we do not expect to happen, but we continue to go with the inverted yield curve. There is a lot of history that says you shouldn't ignore that as if it happens. But we decided to add more things that had to do with interest rates and inflation, which kind of go potentially hand in hand. So we are going to be watching the 10-year bond, that it doesn't go above 3.5%, but not in a vacuum. We also are going to be watching if inflation goes above 3%, then that again would be a supplemental trigger to the one that we were watching last quarter as well, which was the inverted yield curve. Again, we'd like to thank you for tuning in, and we'll look forward to seeing you again in 2019.